This episode of the Alt Goes Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts Going Mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to creators
Mainstream.
to the person who's collecting trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alt Goes Mainstream podcast. Today's show features a guest who brings a wealth of common sense to wealth management and asset allocation. We talk with Ben Carlson, the Director of Institutional Asset Management at Ritholtz Wealth Management, a $5 billion AUM wealth manager. He's managed institutional portfolios for his entire career. He started out with an institutional investment consulting firm where he deployed portfolio strategies and created investment plans for foundations, endowments, pensions, hospitals, insurance companies, and high net worth individuals. More recently, he was part of the portfolio management team for an investment office that managed a large endowment fund for a charitable organization. Ben is a student of markets and asset allocation, which is clear from the knowledge he shares daily and weekly with his blog, A Wealth of Common Sense, and his podcast, Animal Spirits, with Michael Batnick and Ben Carlson. He's authored 4 books about saving, investing, and money, and he was named to the Investment News 40 Under 40 list of top financial advisors in 2017. Ben and I had a fascinating conversation about the adoption of alternatives in the wealth channel and the whys and the hows of asset allocation. We discussed why asset allocation is the most important aspect of an investment plan, the question of whether or not investors now have too much choice, why Ben documents every investment decision he makes, the benefits of private markets, the pitfalls of private markets, his biggest lesson learned in investing, why crypto has helped younger investors become more comfortable with volatility, for better or for worse, the future of wealth management and what won't change about the advisor-client relationship, and the power of content creation and how it helps him approach investing. Thanks, Ben, for coming on the show to share your wisdom and experience in investing and asset allocation. We hope you enjoy.
Collision of culture and finance.
We're going mainstream.
Ben, this isn't the compound, but the tables have been turned. Welcome to the Alt Goes Mainstream podcast.
Glad to be here.
Pleasure to have you. I think you bring such a fascinating perspective to the worlds of wealth management and private markets in a number of ways. So would love to start with your background. How did you end up in asset allocator world and wealth management?
I didn't really know what I wanted to do coming out of school. I knew I wanted to be in the finance world. And the good thing about finance is there's so many different avenues you can take. I had interned with a sell-side research analyst in college and realized pretty quickly that I'm not very good at following companies and tracking them and doing all the financial reporting. And these people were doing forensic analysis on the financial statements. I realized pretty quickly that just wasn't going to be for me. I just didn't have the right mindset for that kind of ordeal. I realized quickly I was not going to be the next Buffett. So I went into the institutional space and I worked for a small consulting firm that managed money mostly for hospitals. And I learned pretty quickly that even though hospitals are nonprofits, they have a lot of money. And the guy that I worked for ran this small consulting firm on the southeast side of Michigan, and he managed money for most of the big hospitals in the state. He had done it for years and years for one hospital, and then all these other hospitals approached him and said, "Do this for us. You're so good at it." The biggest thing for me is that he really drove home the point of asset allocation being the most important thing in the investment plan, because all these hospitals had different funds. They would have an endowment, a foundation, an operating fund, maybe a liability malpractice for if the doctors get sued, that sort of thing. So some of these hospitals might have had 5 or 6 funds. Early on, a lot of these places would come to him and they'd have all their money in one bucket, and they'd have like a 60-40 portfolio or something. And he'd be like, well, don't all these funds have different objectives and goals? It doesn't make sense to manage them all the same way. So he'd split them up and he'd give them each their own asset allocation, their own investment plan, their own risk guidelines, all this stuff. Still doing money manager selection, but he kept it to a concentrated number of money managers per asset class. But he said the big first step is that the asset allocation has to be right. If you don't get that first step right, you can be great at selecting money managers, but it's going to be way harder to stick with. So I got a really good introduction, my first job ever out of college, into understanding the importance of asset allocation. I still have a lot of those same truisms that my first boss taught me back in the day that I still use to this day.
So asset allocation, as asset allocation seems to be changing, we seem to be moving away from a 60-40. How do you now think about asset allocation?
I think the building blocks are still the same. It's your risk profile and your time horizon. The risk profile is your willingness, ability, and need to take risk. I learned that stuff in CFA, and I don't think any of that stuff has changed. I think every organization or individual or family office or whoever you're talking about needs to first think through their time horizon and what their goals are and their risk profile and all that stuff. And I don't think that stuff will ever change. I think that stuff is still the heart of everything that you do. I think the big difference now is that we have a world of choice that we never had before. Back in the day, it was mostly institutions had the availability of different strategies and funds and sectors. Now everyone has the ability to implement different strategies on the public and private market side. So I think the choice architecture is way more important. I think for a lot of investors, defining not only what they will invest in, but what they won't invest in, because there's just so many choices now.
So let's take the supermarket analogy. You go to a supermarket, there's so many choices. Sometimes there's paralysis by analysis. Is choice better for investors or worse?
For some, it's worse because you have temptation to constantly jump around and move and change your portfolio. I think that can be bad for certain people. I think that, especially for individual investors and people that work with advisors, it's been great because not only you have more choice, but the fees have come down and everything is more efficient and you have better tax efficient structures to invest in. And the ability to customize strategies and do things like tax loss harvesting and all these different things that you have. I think that stuff, if you know what you're doing, can be a wonderful thing to individuals. But yeah, I do think that paralysis by analysis is a real thing. And the temptation to constantly say like, wait, why don't I have more of this? Why don't I have more of that? And now I should go into this. I think that part of it is really hard for some investors because it can be very overwhelming.
When you think about the concept of choice, and I love how you broke asset allocation down into frameworks, risk profile, time horizon. That differs by investor, type of investor. You've worked with and dealt with a lot of different types of investors. But if you think about the concept of choice, should people really be distilling it down to things like liquidity or illiquidity? Or I want exposure to something specific or not? And if they do that, then maybe they can distill down what they really mean by choice.
Yeah, well, I guess the time horizon thing probably comes into effect with the liquidity and illiquidity thing. If you have a much longer time horizon, that's one of the reasons that all the college endowments got into illiquids in the first place, is because they had a perpetual time horizon. And they said, well, if we're not going to touch a lot of this money for years and years and years, we don't need the liquidity. So that makes sense in terms of thinking about time horizon. I do think risk factor for a lot of people is another thing. Like, what are you trying to get out of your specific strategy? What are you trying to accomplish? I think some people probably approach it with the mindset of we're just looking for the best investments and put them all together and see what happens. Whereas I think you have to have some sort of overall direction and understanding, like, sure, this might be a good investment for someone, but it might not be a good investment for what you're trying to do with your portfolio or for what the other moving pieces do. So I think you have to have a good understanding of all the moving pieces within your portfolio to know whether or not a strategy would fit within that framework.
I think that's a really interesting jumping off point to the evolution of your career. You worked with a number of institutions as an institutional allocator. You now are working with the Wealth Channel at Ritholtz. What did you learn from being an institutional allocator that you've applied to working with the wealth channel, building out the institutional and family office division?
I say from the investing side of things, working with those institutions, it was just a few more zeros. The risk profile, time horizon, allocation stuff, that stuff was still the same. Tie your investments to your goals. That's the same among institutions as it is among individuals, even if they have different time horizons and goals and such. But I really learned the importance of communication with institutions because it was so much more political. You're dealing with donors, you're dealing with boards of directors, you're dealing with investment committees. These people are volunteers in certain cases at nonprofits, so they might not be having their total attention on this at all times. You have people coming in and out. So the politics of investing in institutional portfolio, I learned very quickly that it's not just dealing with the portfolio, you're dealing with people too, and keeping these people happy. Then you have someone coming in who's a new member of the committee and they want to change things. Getting back to my first boss, the biggest thing he taught me was the importance of documenting every decision you make. All the investment plan has to be documented because if someone comes in who's a new person on the committee or new person on the board and they say, listen, we have alumni who have access to these funds. We want to put this in here. We want to take this piece. And they may think they're helping out, but in reality, they're just totally trying to mix things up and change things. That's not always a good situation for an investor to be in or for portfolio to be in. And so I think if you have everything documented and well communicated to everyone, so everyone knows what their roles are and they know when a decision should be made and when a change should be made and how portfolios should evolve over time, I think that's very helpful. So taking all of that importance of communication and having a plan and documenting and then applying that to individuals, it was actually a lot easier in my mind to work with individuals. Now it's a different set of challenges and circumstances with individuals, but the decisions happen a lot faster. As you know, when you're dealing with a board or a committee, I would say it's just like turning around a battleship. It takes a long time. If you want to make a change, I want to add these hedge funds to my portfolio, or I want to add private, whatever. It takes a long time and a lot of meetings and a lot of cajoling to get people to actually get on board with it and actually make the decision to make a change. Well, we have a meeting in 6 months. We'll talk about it then. And oh, we didn't get to it this meeting, so we'll talk about it at the next meeting. And so I learned the importance of just the communication piece. And I think that made my job working with family offices and individuals and smaller institutions a whole lot easier.
I want to go to something you wrote recently. You wrote a bunch of great pieces on markets, investor behavior, et cetera. You wrote one piece recently about the 60/40 portfolio and its win rate over a 20-year period. That kind of gets to the concept of patience. Is that the right way to invest? Is there a better alternative when you think about portfolio construction or ways to approach investing, whether public or private?
I think I'm stealing this from Cliff Asness, but I think he had a quote one time where he said, no one actually holds a 60/40 portfolio. We hold it up on a pedestal as like the benchmark. I've always tried to get some research on where it actually came from, and I've never got a good answer. But I think I look at something like that benchmark as sort of the baseline to start with. It's not perfect by any means. I think we saw that in 2022 when the stock market went down because of the bond market. And there's a lot of people who said, whoa, I'd never had to think about the bond piece of my portfolio. Now I really do. So I think it's a good baseline for a lot of people. And then you make decisions and branch off from that framework. And obviously, for many people or institutions, especially, they come to the decision that, well, that's not nearly enough equity exposure if I'm trying to grow and I have a long time horizon, that sort of thing. But I do think the 60/40 is a good balanced benchmark to sort of set as a baseline. And for like individuals, thinking through retirement planning, something like a target date is a good baseline to think through, like, can I do better than this? Maybe, but I could also do a lot worse.
So from that point, and we talked about choice and the paradox of choice a little bit earlier, it's a really interesting philosophical question. Should more investors try to be as simple as they can? Or should they become more complex now that they have all this choice? They can invest in alternatives, they can invest in evergreen funds. How do you think about all of that?
That was probably the biggest thing that I butted heads with people in the institutional space. Is I thought many of them were far too complex and more than they should be. And the reason I say that is because I don't think a lot of people understand what goes into the Yale or Harvard endowment model and all the people and experts that they have that are picking those funds. They had a department for hedge funds and they had a department for private equity and venture capital. We had a $1.5 billion endowment fund. There was three of us. You know, the network was a lot of peer-to-peer networking and talking about managers. It's funny how much of that whole space really was more behind the scenes talking than you would think for all these huge billion-dollar pools of assets. A lot of the discussions happened behind the scenes with other endowments and foundations that were similar size as yours. And that was the case at many of them. It was small teams, 3, 4, 10 people, maybe. It wasn't these 60-person offices who had the resources and the ability to source these managers and look at them. And so I always thought that if you're going to be complex, it's not necessarily the wrong way to go, but you better have a good understanding and the expertise to handle that complexity. I feel like a lot of the institutions that we talked to, they didn't have the resources or the board buy-in to do it.
Really important and interesting point in two contexts. One, where my mind goes with that comment is, does creating complexity often lead to better returns?
I thought no, because here's the reason why. I think simple is harder in some ways because you have to make a lot of the decisions up front. You have to do a lot of heavy lifting ahead of time. And I think the hard part about complexity for a lot of people is if you don't really understand an investment strategy, it's really difficult to double down and rebalance into it when you need to. In understanding when that strategy or that asset class goes through its inevitable period of underperformance, because they all do, are you willing to rebalance your portfolio or put into the next fund with that manager or whatever it is? And a lot of people, it's just easier to say, I'm going to rip the band-aid off and move on to something else because there are all these other choices now. And I think that's the problem with complexity is instead of understanding like, okay, sure, this asset class or strategy or manager, they're going through a rough patch or they got killed. Instead of backing them and putting more money in or holding tight, it's easier to just, I'm out. I'm doing something else.
So, on that point, as it relates to private markets, you're now seeing a lot of new structures being created. One example that I think relates to both individual as well as institutional investors is evergreen funds. So, the ability for people to invest in these new structures, get invested right away, start compounding in theory. And interestingly, not just individuals, but institutions are also thinking about using this as a core way to get exposure to, say, private equity, maybe private credit in some cases. Do you think the advent of these new strategies and structures is making it easier for investors to be more simple, but also allocate to other things?
Yes, I think that those strategies make a lot more sense, especially for the wealth channel. When I first came into the institutional space, I was the young analyst on the team. So I was tasked with tracking the venture capital and private equity cash flows. What I learned quickly is that the operational aspect of that is way more complex than most institutions and individuals understand. You're dealing with constant capital calls and distributions and money moving here and there. You have to figure out how do we equitize this piece. We put down that we want to give $10 million to this private equity fund, but you don't give the $10 million on day one. It could come in dribs and drabs over 5 to 7 years or something. So what do we do with it? Do we invest it in an ETF while we're waiting? How much do we keep in cash because we're going to have? So I quickly learned that tracking all these cash flows and the operational aspect of it was way more complex than I ever would have imagined. And so taking that piece out of the equation, I think makes it a lot easier for everyone involved and probably easier for the manager too, obviously.
So, from that perspective, what are your views on private markets?
I think my views have evolved over time. Coming out of the institutional space, for those certain institutions, I came out of it with a bad taste in my mouth. I came out anti, and I was thinking this should only probably be for a certain subset of organizations that actually can handle it, because a lot of them really can't, and it's probably doing more harm than good. Especially because most of those smaller institutions that I was talking to and working with, they didn't have access to the top quartile funds. Even if they wanted to, they couldn't get access to some of these funds. And the range of outcomes between the top quartile and bottom quartile, as you know, is way wider in some of those spaces. So if you're wrong, not only do you have this illiquid holding that it could take 10 to 12 years to even know if it's any good or not, it's probably not going to be a very good outcome for you. You're not going to get much money back as you would in a better fund structure and a better manager. So I came with a bad taste in my mouth. I know that seeing a lot of the way that it's evolved over the years, I do think that a lot of these changes have helped investors. And I'm obviously far more curious now the way things are, the fact that we are starting to see this on the wealth manager channel. And I think that's made consumers and investors a little more open to these kind of fund structures as well, because they didn't want to deal with all the complexity either.
Yeah, I think you're bringing up a number of really interesting points. And I'll first surface something that's a really interesting observation, which you said about smaller institutions, which actually mirrors that of the wealth space in many regards, where you have firms managing billions of dollars, and yet there's only a few people maybe responsible for manager research, which is commonplace in the wealth channel, just like it is in the institutional channel. There's obviously ways to remedy that, but it seems like there are actually a lot of similarities in that sense. So the question then becomes, to your point, how do you get access to the right types of investment products? Now, as we were discussing, there's more choice, more types of ways to access alternatives through things like evergreens, et cetera. So how do you think about private markets from the wealth channel perspective and how a wealth investor or wealth client should approach that?
Well, I think the first thing to note is that the RIA space is just so much bigger than it was. I don't have the good estimates offhand, but I know that everyone wants a piece of their RIA channel now. The old line of thinking was, and it's funny, when I worked for the institutional space, there was sort of this hierarchy I mentioned when you were on our podcast, just that the foundations and endowments thought they were up here and they thought they were a bunch of, above the pension plans. And then when it got to retail, people thought like that's just the leftovers of the leftovers. And now the RIA space, because it's so big, I think that that's not the case anymore. That people think going to this retail, when you have these managers that control trillions of dollars now, there's a lot of opportunity there. There's all these different fund structures that want a piece of that because the institutions can't. They've already allocated there. They're already up to 30 or 40% in some cases in alts. So there's not much more opportunity in that space. There's not much more juice to squeeze. So from that perspective, I think the opportunity for wealth managers is greater than it was because there actually is maybe access to better fund structures. I think a lot of it depends on the knowledge of the wealth manager. And so I think for a lot of people, some wealth managers have said, listen, no, we're Vanguard 60/40 index fund. That's it. DFA, we don't look at anything else. This is it. Blinders on. I don't think a lot of clients like that anymore. Even if your answer is no, we're not doing privates at all, I think you have to have some knowledge on it and you have to be educated and understand, at least provide a good reason why. Because clients want that. Whether you as a wealth advisor think that it makes sense that they need it or not, clients want to at least have a good answer. The same thing when we went through this with crypto a few years ago too. You at least had to have a good answer. I don't think it's enough to just say, no, absolutely not. That's fine to say, no, we won't do this, but I think you have to have a good answer. I think that's what a lot of wealth managers are realizing now is we have to have something, especially if you're moving up the ladder in terms of client size. And for us, I've witnessed Ritholtz Wealth when I started, we were essentially like a startup. I was the fifth or sixth person who joined the firm. We had $140 million under management when I joined. We now have 60 plus people and we're managing $5 billion. And we've slowly but surely moved up the chain of managing money for people with $5 million. And then our biggest client was 20 million. And now we're hundreds of millions and billions. And so we're dealing with bigger clients. And some of them want or need access to and exposure to alternatives. And I think you have to have some sort of strategy for those types of clients if that's the waters you're going to swim in.
A few really interesting points in there. One is, how do you go about as an advisor, or what would your recommendation for other advisors be, having gone through that journey as a firm yourself? You were obviously well versed in alts before you joined Ritholtz, but how should advisors go about getting smart on alternatives, to your point, whether or not they end up allocating to it?
I think starting with some of the platforms probably makes sense. There's a ton of alt platforms now that will sort of do this for you. And that's probably the hardest thing. We talked about choice architecture before. Alternatives is a pretty wide range of options. Even within private equity, there's all these different types of private equity funds. We have private equity and venture capital. And if you went to hedge funds or alts, you have all these different types of hedge funds as well. So I think that can be daunting for a lot of people. Figuring out what types of alts you're going to invest in the first place. So I think it could be helpful to talk to some of the different platforms that will give you access to managers that are on their platform. I think that's a pretty good place for most wealth managers to start, and hopefully have those kind of places help educate you, because it can be challenging if you're just going and looking to do manager research on your own. Most advisors want to be financial advisors. They want to do tax planning and estate planning, and insurance planning and financial planning for their clients. They don't have the bandwidth or the knowledge or the investment acumen to go out there and find managers. Some places have that sort of team, but it's pretty rare for smaller advisor groups.
The other thing in there, and what you just said, and what you said prior, I think is a really interesting concept to unpack as well, which is advisors have other pressures on their time, but some may want to carve out the ability to find managers or at least have an expertise in alts. The other piece of this is as advisors grow, and some are private equity back now, to your point, everyone wants a piece of the RIA channel, and maybe for good reason. Do you feel that there is a pressure as an advisor or wealth management platform or firm to offer alts if there is a growth ambition?
Yes, we had this transition in the last, call it 10, 15, 20 years, going from active management to passive management. And I think that was bigger in the RA channel than at other places of wealth management. I think a lot of advisor firms went through that, but then looked around and said, oh, shoot, we need to differentiate now. We made the change. We saved the client money on fees. We got them into indexing, and they're probably outperforming the active management funds they were in before. But now they can just go down the road and get the same index portfolio from someone else. And so how do we stand out? And so I think there was a lot of that. And they probably started with some more niche strategies in the ETF space, maybe some alts there even, and then now are looking at some of these other alternative spaces. And the private credit one seems to be the big one these days for advisors. So I think a lot of advisors are trying to figure out how do we differentiate from all these other advisors. Now that people don't just go to the advisor down the street from them, they can find an advisor anywhere around the country through the internet.
So if we take the lessons learned from what you just covered on differentiation, and now we extrapolate that to private markets. Now many advisors, if not most advisors, can get access to the platforms like iCapital or Case or otherwise. And that's almost table stakes now in terms of their ability to access alts in a sense. That no longer becomes a point of differentiation. What's the next frontier for advisors in terms of differentiating themselves with a private markets expertise or perspective?
That's a good question. Yeah, you're right. Everything becomes a commodity eventually. I think for the larger clients, a lot of it is probably co-investments and direct investments. I'm going to bring you this deal. We have access to this one deal. You're going to be in on it. And maybe you don't pay as much fees as you would. You don't pay any management fees. You just pay the back end. I think that probably for certain, I think there's going to be tiers to this kind of thing. And then we do that at our firm. We have a certain threshold. If you're going to think about investing in this kind of thing, we have a threshold level of assets that we've defined to even start to think about this, because we think there should be a level in terms of adding that complexity, whether you need it or not. So I think there's going to be sort of a tiered system, and it's going to be more access, I think, is going to be a big part of this. Well, yeah, sure, you can get this private equity manager somewhere else, but can that private equity manager also get you in on some of these other deals? I think I can see that being one of the next steps down the line.
How have you thought about differentiating from a private markets perspective and also getting access, like you mentioned?
Culture is a big part of our organization. And we think that's part of the thing that helps differentiate us from other advisors. And we want to work with private managers who have a similar idea on culture and being a cultural fit. Most advisors get pitched from all sorts of different places. You get the emails coming in all the time, and we're only interested in talking to and dealing with ones that have a similar mindset in terms of culture. So maybe smaller in size and not these huge pools that you can get other places that don't really differentiate yourself. So I guess for us, it would be more staying away from some of the name brand alternative asset managers, which there's nothing wrong with, but we just don't think that really fits our sort of style and culture and the way that we view these things.
So two questions there, because I think they both relate. One is, how would you define your culture at Ritholtz? And then how would you go about evaluating managers and their cultural fit with you?
Well, I think we kind of positioned ourselves as like the anti-Wall Street firm at first, kind of the no BS, but also we wanted to be totally transparent and open with people. And that's why content is such a big part of everything we do. We didn't want to be one of those old firms that when back in the day was like, trust us, we got this. That was kind of the old way of doing things. We're a black box, but just give us the money and we'll take care of it and you'll be fine. We'll supply the recommendations. You maybe say yes or no, but we wanted to be more transparent and be on a sort of level playing field with our clients and be upfront and honest with them. Like, this is what we're going to be willing to do for you. Here's how we're going to do it. And then after the fact, we're going to show you this is what you wanted. This is what we're actually doing. And we also wanted a firm where we wanted to partner with the right type of clients. And we thought right away, if you're just taking on every single client that comes to you and they're not a good fit, that's a waste of your time. It's a waste of the operation team's time, the traders. it's a waste of the client's time because they're probably just going to leave in 6 months anyway. If you promise to do something for them, something that which you can't or won't do. So partnering with the right clients was also a big thing for us. And so I guess that's kind of a similar way we look at these sort of alternative managers. Is it something that me and the other partners at the firm would put our own personal capital and that sort of thing? So I think we look at it from that framework as well.
Is there something there that you do when talking to managers to understand cultural fit? Because I find that, and you've gone through this in a number of ways and vantage points as an institutional allocator and as an allocator at a large wealth management firm. But the meeting the manager is always important, and you can have a process, but it also ends up being so qualitative. Is there a way that you can figure out culture fit by having some form of uniformity in the process in which you do that?
Yeah, it's almost like the old Supreme Court judge said, I can't divine pornography, but I know it when I see it. You're right. It's so qualitative. I guess for me, the big thing I learned back in my manager selection days is I always really gravitated towards the ones who would be upfront and straight with you. And I hated it when a manager would underperform and then make excuses because I thought it was better to just meet it head on and say, listen, we were positioned wrong. We made a decision. It didn't work out for us. Or um, our style of investing is just out of favor right now. Or just, I don't know, like saying, we don't know what's going to happen, but here's how we're positioned. I never really liked it when the manager would turn around and say, well, we would have been right if it wasn't for the Fed or if it wasn't for the government stepping in or whatever it is. So I always gravitated towards those managers that did have some sense of humility, but also transparency and intellectual honesty. Those are some of the things that I look for too in the answers. But again, you're right. It's very qualitative. And I feel like that's the kind of process that's always evolving. And yeah, it's kind of like hiring people, right? There's no good one way to hire the right people for your organization. Same thing.
I think you're hitting on such an interesting point, and I want to tie what you just said on managers being upfront and being direct and transparent with you, content creation. And we talked about this a little bit earlier, that part of the magic of content creation is you're able to show the world what you think and who you are in a very transparent way. And tie that with, you recently talked about on one of your Animal Spirits podcasts, the history of star portfolio managers. You wrote about it on your blog, Wealth of Common Sense, as well. Tying all those things together, is there something in today's world of investing where social media is so prevalent, managers can be out there, they can be talking about things, they can have a blog, have a podcast, that can differentiate today's star fund managers from maybe star fund managers in the past?
Two things there. One is it's never been easier to have confirmation bias if you want it, because there's opinions and analysis everywhere and you can look kind of where you want. So there's often the case where if you have a star fund manager that's out there and they're very certain about their ideas, that can be very appealing to a certain subset of people. But Josh Brown, our CEO, always says that right or wrong, people like doing business with other people that they like or respect. And so I think part of the content creation strategy, it sort of shortens the window to a yes or a no from a client or a prospect. Either they really like you and they'll say yes quicker, or they know immediately, listen, you're not for me. So I think it shortens that process and makes your life a little more efficient. It's like a self-selection kind of thing where you're going to get the people that have the similar values as you. Our whole ethos is our philosophy is universal. The strategy for the clients is personal, but our philosophy is kind of take it or leave it. I think clients like that. We've spent years crafting that narrative. Now, as you know, financial advisor clients, it's not like they just say, here, take my money right now. It's usually some sort of event happens in their life. Someone passes away, someone gets an inheritance, someone gets a new job, stock options vest, whatever it is. And then they think, well, who do I need to talk to about this? Because I have this complex situation. Oh, maybe these people that I've been listening to for 5 years, I kind of like them. I'll go to them first. And that's the idea behind like the content creation strategy, is just being top of mind for people if they happen to agree with your value system when it comes to managing finances.
I think this lesson can be applied to either wealth managers or fund managers trying to build a brand. But you mentioned that Ritholtz was a startup. You joined when it was a startup, and you had to build a brand. You had to create content. What were the hardest parts about creating content and building a brand when you were a startup, not the 5+ billion of scale that you have today?
I think we were lucky in that none of us set out to build a brand at first, because I think now that's a strategy. And when we did it, I was personally, I knew I needed to do something else. I enjoyed working on the institutional side of things, but I was working for $1 billion fund, and I think they were going to be fine either way. It was an endowment from $1 billion family. They were going to do good either way. It was intellectually stimulating, but I was ready to work with other types of clients and investors. And so that's why I started writing, because I just felt like I needed an outlet, and writing to me was an outlet. Josh Brown did the same thing. He was an old school broker, and he decided he needed an outlet. So he started writing. And Bear Ritholtz, our firm's namesake, was an investment strategist. And so we all started doing these content things separate from one another, and then sort of joined forces. And so we did it because we enjoyed it at first, and not because we were trying to build a brand. And the brand stuff came later. And when we joined forces and realized, oh, this content thing actually can be a powerful way to get a foot in the door, then we decided, okay, now let's put our foot on the gas and really take advantage of this. And then we had more of a strategy. But at first, we didn't have much of a strategy. So I think the best thing that happened to me is I had little expectation. When I started writing, I was doing it just for family and friends, because I was getting all the questions from them. And I'm like, I'm going to write a blog in plain English that my father-in-law would understand, because he's always asking me questions about investments in the markets. If I would have had these big expectations of I've got to build a brand and a huge audience in the first 6 months, I would have given up, because it didn't happen for me. It took a long time for people to finally start reading it. So I was doing it more for like personal growth than for brand building.
On that point, how do you maintain that mindset? Almost that like youthful, like, I'm doing this for myself. It's probably helpful for others too mindset as you build a brand, because you've now built a brand, have a ton of followers, have to write stuff. How do you think about that?
I think part of it is I just grew to love it. I was never really a writer before I started a blog. It wasn't something in high school and college that I loved doing. I think I found the topic that I needed, and I found my muse, or whatever you call it. And I find it personally satisfying, because it helps me take all these jumbled up thoughts that I have, and writing makes you organize your thoughts. And what do you really think about something? So that learning curve, I felt like it was the flywheel of I had to keep learning more and reading more. And now it's just part of my process. And half the time, I almost pretend like someone isn't on the other end reading it, or listening to the podcast, or watching the video, or whatever it is. And I just think, how does this help me be a better communicator? And it's funny doing that. I mentioned this before the podcast, has helped me become a way better communicator with clients that I talk to, because I've already gone through the process of thinking through these things, and I can put it into a more framework when I talk to them, because I've already gone through the process of doing it.
From that perspective, you did this in such a natural way, and it comes from a place of just wanting to learn and continuing to learn. There are a lot of advisors coming into the business now as younger people, less than there were before. So their skill set and upskilling them is going to be even more important. What advice would you give to younger advisors in terms of how they learn in a very natural way, and maybe do some of the things that you did in their own way, though?
I do get a lot of questions from this, and people ask me, how do I build an audience, or how do I start a blog? And I always tell them, don't go from that framework. But I look at it from the perspective of, who are you trying to help? I think as an advisor, you understand what kind of questions you're going to get from your clients. And my thing is, try to answer them in advance. If stocks are rising, there's going to be certain questions. If they're falling, there's going to be certain questions. The same thing with inflation rising or falling, or interest rates rising or falling. Depending on the environment, you're going to get similar questions. So I always say, start answering those questions in advance, and try to build some sort of newsletter that you start slowly building up a group of emails and sending out to people on a regular basis. And then when the client inevitably does ask the question, you go, oh yeah, I wrote about this 6 months ago. Let me send it to you. And then you've kind of proven your expertise, and you're building a library of knowledge. And that's one of the things our advisors love so much. For some reason, I have like this photographic memory of all my blog posts. So an advisor will Slack me once or twice a week and say, hey, have you ever written about this before? I got a question from a client. I'll say, yeah, here it is. Here's the blog post. Then they just send it to them, and it's already been done and thought of. And that puts the client at ease. Okay, I was worried about this, but my advisor has already thought about it, and they've worried about it in advance. And so that's what I tell people is, just answer those questions for your clients and start building a library. And don't worry so much about the audience. Worry about helping your clients first. And then if enough people like it, maybe something will happen with it. But that's the whole idea, trying to put your clients at ease, that you've already thought about all the worries that you know they're going to have.
Another way to describe building a library would be compounding. And I want to take that as a chance to ask you from an advisor's perspective about private markets, starting with the concept of compounding. So that could either be done in public markets or private markets. There's even a private equity approach to public markets investing of buying great businesses and holding them for the long term, even if they're different liquidity mechanisms, et cetera. What are some of the principles in your mind? How similar are some of those principles between good public and private markets investing?
Well, I think one of the biggest benefits of private markets is the fact that they almost force you to be a long-term investor. We talk all the time about getting clients to think and act for the long term because that's when your results improve. The odds of success go up the further out your time horizon goes. I think every advisor preaches that, this whole stay the course thing. And I think a lot of public market investors, especially the managers, they get mad at private investors because it's like, you don't have to deal with this daily pricing and the wild upswings and up and downs. And from a behavioral standpoint, that's actually a benefit of private investments in my estimation, just because you're forced to become a long-term investor. You don't have a choice if you're getting in on one of these illiquid investment structures. You have to hold it for a certain period of time. And I think taking that behavioral component out of the mix is a huge benefit. And again, it can be a detriment too if you pick the wrong fund structure or the wrong manager or whatever it is. But being forced into being a long-term investor, I think, is the big benefit for investors.
It's a really interesting point. It's almost the concept of illiquidity saving investors from themselves, in a sense, and their emotions. On that point, what excites you most about private markets?
I think the fact that the fund structures continue to change and evolve, especially as demand from investors changes, just seeing the sheer growth of this private credit side of things. I don't know anyone could have imagined that coming out of the financial crisis that this would happen and that you'd get this relatively new asset class or fund structure for clients that was built that I think people are still trying to better understand and people are asking questions about still. But the sheer growth of it is immense. And the fact that there's going to be people who will fill holes when they're there and when advisors need them. And also just the way that the cycle goes, depending on the environment, the types of managers or asset classes, right? After the financial crisis, hedge funds were huge, especially in the institutional space. Everyone wanted a hedge fund because they just lived through the crash. And then you have a bull market and privates go crazy and private equity is great. And then it's venture capital because of technology. And I think just seeing the evolution there, and that part of it is a lot like public markets, obviously, where we're chasing the hot dot and people are trying to maybe backfill a little bit of what they wish they would have invested in. And watching that cycle play out in privates the way it does in publics is interesting to me.
The concept of structure, we talked about this at the beginning. I want to ask a question related to this in a slightly different context, which is, how do you think about the definition of alternatives? And how does that relate to structure?
It is tough because, again, there are so many different types of them. But I guess the way that I look at it is something that is different from traditional stocks and bonds. Because an alternative can be in a public market structure. There's alternatives in ETFs. It doesn't have to be an illiquid fund structure. So I think something that diversifies traditional stock and bond portfolios.
Do you think that definition will change over time?
It could. I think stocks and bonds for most investors will always be the building blocks. And then there will be other forms of investing that will come along with it. But you're already seeing in the past 5 years or so, this huge influx of option strategies and like defined outcome strategies and ETFs. And that's coming from more of the insurance side of things. So those are alternatives, but that's not even from thinking through the endowment foundation space. That's more like insurance type products that retiring baby boomers are clamoring for. And again, that's the interesting thing to me is if there's some void there or some demand or some problem to be filled, it will be met by the market in some way.
Do you think that younger investors will approach investing differently, whether public or private markets investing?
I think younger investors will be more open to these types of strategies because they've grown up in a different world. Obviously, a lot of more young investors are open-minded to something like crypto. I think that actually helps them in a lot of ways because it makes them more immune to volatility. If you've started off investing in crypto, you're certainly fine dealing with volatility. You've dealt with 24/7 markets and huge crashes and huge run-ups in price. And so, yeah, I think young investors probably will have a different mindset and maybe be a little more widely diversified than people that came before them.
That's a really interesting point. I had the CIO of Bernstein Private Wealth, Alex Chaloff, on the podcast, and he said, in the context of younger investors investing in different ways than maybe prior generations, their return expectation is maybe out of whack. His quote was something to the effect of like, you walk out the door and you expect a 20% return to just hit you in the face. How does this concept of younger investors being more comfortable with volatility, How do you think that helps them as an investor? But also, does it hurt them as an investor?
I think a lot of people have seen, especially this cycle, this past, whatever you call it, 10, 12, 15 years, as long as you hold on, even if you're going to have some downturns, you're probably going to end up okay. And at a certain point, that doesn't always happen. So that can be harmful if you think that applies to every single asset or strategy. If I just keep holding on, it's going to come back, because some strategies and some stocks or some securities just don't come back after they crash. They kind of just go away and never hit those heights again. But yeah, I think people are going to be more willing to take risks. And I think it's also in certain parts of their portfolio. Most people have their sort of 401k, IRA, retirement stuff on automatic. It's a target date fund or it's an index funds, and it's automated and it's happening behind the scenes. But then with their brokerage account, and that's 10% or 20% of their portfolio, now they're taking more risks and they're trading options and they're buying crypto and they're trading stocks and all these things. That's a lot of the young people I've talked to. They have this separation, and they've mentally bucketed out these different types of risks. And so they say, well, if this is taken care of over here, I can take these risks over here and it's going to be okay because I have this other piece that's my fallback. So I think they're actually being a little smarter about it in most cases, rather than just YOLOing their whole portfolio.
How much is the advisor going to have to change the way that they operate to recalibrate and work with younger investors?
You probably have to be a little more open-minded about certain things. But again, I think the advisor has to be open-minded too. And we have clients who come to us and say, listen, I want you to do this for me, but I really still like trading stocks. And we'll say, okay, fine. Here, take 5% of your portfolio. We're not going to advise you on this at all. We're not going to take fees or whatever. So go ahead and do it in your brokerage account. And if that scratches that itch, good. So I think you have to be open-minded, and you can't just say, no, that's a horrible decision. That makes no sense. You have to be 100% stay the course, index funds, 60-40, whatever it is. I think you have to be a little more open-minded about that, especially from a behavioral perspective. If playing around with 5 or 10% of your portfolio is going to allow you to keep the other 90 or 95% humming and running on automatic and rebalancing and asset allocation and diversification, I think that from a behavioral perspective, that makes a lot of sense to me.
What do you think the future of wealth management looks like?
I think it's going to be more customizable. You've seen the big boom in direct indexing in recent years. That's been our biggest growth engine in terms of creating more bespoke, especially for tax purposes, investment purposes. I think customization, especially for high net worth and ultra high net worth individuals, that's going to be a big growth area for advisors. I don't think it's going to take off in the retail world like ETFs or something did. I think it's going to be more in the advisor channel. I do like to think through the Bezos framework too of what won't change, though. I think a lot of the advisor stuff is still going to be fairly similar. It's really a relationship built on trust and service and having empathy for people. And obviously technology is going to play a huge role going forward. But I think a lot of that technology is going to make the advisor's life much easier. I don't think it's going to challenge advisors in terms of competition. I think more of it's going to be working hand in hand with advisors. But I think a lot of the building blocks will remain the same.
Is that even the case as the wealth management industry goes through its own private equitization of growth ambition from these firms now that they are backed in many respects by private equity, or maybe over time the desire to be on a growth path and take outside capital?
I guess my biggest concern there would be, where does the client fit in? The advisor gets a nice buyout. The private equity firm gets a really high margin business. I wonder at what point do clients start saying, you know what, I'm sick of you. You sold your company to this firm, and then that firm bought that firm, and where do I fit into all this? So that'd be my concern with all these transactions going on. Is it in the best interest of the clients, and are they going to be better served? Maybe having a bigger organization will make it better, but I think it could take away some from the client experience if they're kind of shopped around all the time.
It's a really important point of balancing those two things. An industry should absolutely grow, and it will. Alternatives or private markets are going through the same growth path, but how do you keep the client in mind at the end of the day is so important. I want to end this podcast by asking you a question that I ask everyone else. I have asked, in looking backwards, what is your favorite or most interesting alternative investment? But I think this space, private markets in general, is just going through so much change right now. Markets are in an interesting place right now too. I want to ask that question going forward. So going forward, what is your most interesting or your favorite alternative investment?
So I think for us, one of the things that we've done in recent years is we will take a stake in a lot of these new platforms and help them grow.
Platforms being wealth managers.
Yeah, well, wealth managers or different types of technology and stuff that we use as a firm. We get approached by all these different providers and platforms and over the years, and some of them we become users on. And if we're going to become a user, we've thought like we should help in the growth of these firms, not only in helping pushing them forward, but also providing feedback from our advisors and our operations team on ways that they can do better because it'll help us. So I think a lot of that is those sort of firms that we partner with in these technology platforms, whether it be client performance reporting or different systems to help our advisors or trading systems behind the scenes for our operations team. We're trying to partner with more of these firms to help our firm get better and more efficient and our advisors and our operations team work better, but also help these platforms grow. If it's someone that we want to partner with and have a long-term relationship with, we find that really, really gratifying and helpful for our firm.
I think that's such a fascinating point and brings really all of this together is how do you better your business, but also help these firms grow? And I think you've done that in wealth management, capital markets. We share a few investments in alternatives together. And I think that's so important in this space in particular, because many of these firms need the client to really understand how to grow. And if you can help them early on, help them figure out how this actually works from the end client perspective, delivering a certain service, that ends up being critical to their ability to grow.
Yes. And we've had a few startups we've talked to over the years that have said, hey, help us understand the RA channel. And if they don't understand it already, we think it's probably not going to be a good fit. It's a really hard thing to understand. So you want to partner with someone too who understands the space already. And that's a great thing is a lot of it is advisors who are going out on their own and they're solving a problem that they themselves ran into. And those are the kind of people we want to work with.
And I think you guys have done a fascinating job of it. And can't forget Future Proof as well, which you're bringing the whole industry together. And yet you're also right in the middle of that as owners of it as well. Congrats on the comprehensive platform across capital, across content, community, relationships that you built. Thanks so much for coming on the All Goes Mainstream podcast, Ben. Pleasure to have you.
Appreciate it. Thanks for having me.
Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going